We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Dave Kranzler from Investment Research Dynamics and also the author of the Mining Stock Journal and Short Sellers Journal. Dave, how are you today?
Doing well, thanks, Tom. Thanks for having me on the show again.
Always great to chat with you, Dave. And I'm sure today will be no different, but I want to start by kind of getting your feeling going into the election here. Do you think that there are any material differences from either party in terms of going forward on national debt or how their policies will affect the markets and the attitude within the markets?
It's not going to matter which party takes control of the White House in terms of what's happening with the amount of debt outstanding and the increasing amount that's coming. The only thing that's been propping up the economy, because I do a deep dive on hard economic numbers, not just the BS government reports every week for my Short Sellers Journal. And if you strip away government spending, this economy is in a somewhat serious recession already. I mean, manufacturing has been in a recession for 2 years, and it's not getting any better. Mm-hmm. So it's military spending, government handouts, and other areas of domestic spending from the government. And if they slow that down, we're going to have an economic collapse. So that's the problem with our monetary system and the way and the fractional banking system. You have to continuously feed more credit into the system in order to keep the economy propped up. It's essentially a Ponzi scheme. And it's not like Trump or Harris are going to be able to do anything to reduce spending. I mean, the deficits are completely out of control. The spending deficit and this is just off the top of my head from memory, I think it was in July, spending deficit was like $389 billion or something. I mean, it's crazy. And I think we ended fiscal 2024, which is at the end of September, which ends September 30th, with over a $1.8 trillion. I think I like the way they call it a budget deficit. It's a spending deficit. You spent $1.8 trillion more than you took in revenues. And the only way to fund that is with Treasury debt. Mm-hmm. So, and right after the new fiscal year started, fiscal year 2025, at the beginning of this month, within the first 3 weeks, the Treasury debt outstanding increased by $500 billion. So I don't think either party has any control over that.
And it doesn't seem that there's any, concerted effort or really even acknowledgement of what that situation actually means.
Everyone's got their head in the sand on it. I mean, I don't even like to think about it because it's at some point you're going to have a supernova, right? A Treasury debt supernova. And our system's going to implode. I mean, that's a big part of the reason these Eastern Hemisphere and BRIC-allied central bank countries that are allied with BRIC, their central banks are just buying gold hand over fist. Mm-hmm. They're doing that because they're trading out of dollars and euros and buying physical gold. And even more importantly, they're not necessarily leaving them in London vaults. They're taking delivery into their own possession of those gold bars, which is critical. Mm-hmm. So, in fact, gold is now the second largest central bank reserve asset, and that's primarily the Eastern Hemisphere countries, their central banks. I mean, the EU central banks for each country, I think a lot of them own gold, but not as much as they did when we were on the gold standard. And there's no telling what the Fed actually really owns anymore. It hasn't been audited since Eisenhower was in office.
The Fed or the Treasury?
The Fed. Well, the Fed safekeeps the Treasury's gold. So essentially the Fed owns the Treasury's gold. And it's the thinking is that it's been hypothecated or leased out over the years in order to make up for, obviously the large banks that run the COMEX have big paper short positions. And so, when they have to make deliveries, sometimes the Fed has to lend them gold or lease it out. And they also, and I don't know if they're doing it anymore. I don't think they are. I think they may not have the gold to do it. They were, so starting around, I think it was the early 1990s. It was originally a scheme devised by Jay Aaron, which was then acquired by Goldman Sachs in the late 80s. So it actually started probably in the mid to late 80s. They went around and they went to the Fed and convinced it to that it could earn interest on its gold by leasing it out to the banks, who would then turn around and sell it in London. And that's part of how they pushed the gold price down. And probably the most famous instance of that was when the Bank of England sold half of its gold. It sold 400 tons in I think it was late 1998 or early 1999, and that's what it's known as Brown's bottom, because Gordon Brown was the head of the Bank of England, and it was his decision to dump half of their gold. So they dropped 400 tons on the LBMA, and that's what pushed gold down to its final low of 250. And then after that, 2 years later, early 2001 is when the secular precious metals bull market that we're in now began. So it's questionable as to whether or not the Fed even has possession of the gold that it's supposed to be safekeeping on behalf of the Treasury, ultimately the U.S. taxpayers. Mm-hmm. We do know that they had trouble delivering just 300 tons of gold to Germany when Germany requested the repatriation of close to 700 tons. And it was gold that was moved over from Germany after Hitler fell, because the Germans were worried that Russia might invade it. And, when you invade a country and take control of it, the first thing you do is take their gold. that happens with every country. Mm-hmm. So with every invasion, successful invasion. So who knows if the Fed even has possession of the gold that it's supposed to have, the 8,100 tons. Mm-hmm. And a lot of people think that's conspiracy theory, but if it isn't conspiracy theory, then why can't we do an independent audit?
Well, for some of the explanations that I've been given for that is that it's just, very complex and very cumbersome, but it doesn't seem to be a priority on anybody's mind.
It's not complex and cumbersome. You hire an independent audit party, you send them into the vaults, they reconcile the gold bars and the serial numbers on the gold bars with the Fed's record keeping. Mm-hmm. It's not that hard, and it's not that expensive. Hell, the Fed spent something like 10 million. Remember when Ron Paul was trying to pass an audit the Fed bill? And it kept getting blocked from going out of the House Financial Services Committee. And the Fed spent something like $10 million lobbying Congress to make sure that bill never saw the light of day. In fact, they had hired, and I can't remember I think her name is Linda Robinson or Linda Robertson. She was like the chief lobbyist for Enron before Enron imploded. And the Fed hired her to do the lobbying.
Well, she must be effective.
Well, there's a reason why they're fighting it so hard. They don't want the truth out there.
Mm-hmm. Is it possible, though, that it doesn't necessarily really matter that much, because it's in some ways a small part of the Fed's balance sheet, especially that they write it on the balance sheet at $42 an ounce or something like that, right?
It's not about the Fed's balance sheet per se. Mm-hmm. Who cares about that? They can make their balance sheet look like whatever they want it to look. I mean, they're sitting on massive losses on all the fixed income securities they bought since 2020, but they can just print money to make to cover that deficit. So it's about, so this is where this is where we'll eventually run into trouble, because it's obvious that at least the Eastern Hemisphere is at some they're slowly transitioning into a monetary system, and they'll remonetize gold, right? Now that's part of the reason why they're all buying so much gold, because traditionally when we're on a gold standard, central banks 40% of their reserves would be gold. So, and the U.S. can say, well, look, we've got 8,100 tons. We can back our dollar with gold. And if I were China and I'm trading with the U.S. and I'm taking their dollars, the first thing I would do is I need to see that your gold is really there. Mm-hmm. And that's when I've always thought, and this goes back to 2002, 2003. I always thought that the U.S. would rather start a world war to deflect that issue than to have the truth revealed about, the gold vaults. I mean, Germany partially exposed it, right? They asked for almost 700 tons. The Fed negotiated them down. The Fed and the Treasury negotiated them down to 300 tons over 7 years. Well, a few years previous to that, Hugo Chavez repatriated 200 tons of gold from London and I think Paris, and it took them like 6 weeks to get the gold. Mm-hmm. It took the U.S. I think they eventually delivered 300 tons within. They had 7 years to do it. I think they did it within 4 or 5. But a lot of the gold wasn't even the original gold bars that were sent over here after World War II. So, I mean, where there's smoke, there's fire, in my opinion.
Mm-hmm. So in this era of hyper-financialized markets, Dave, is liquidity the only thing that's keeping the markets and the banks functioning right now?
Oh, 100%. 100%. A lot of people don't really, people point to, they say, oh, well, the Fed's got a hawkish monetary policy. It's reducing its balance sheet. Well, they haven't reduced it very much, since they started doing it, the so-called quantitative tightening. But on the flip side, M2 has been growing since October 2023. It's been rising. Most people were looking at the year-over-year percentage change in M2, still thinking that M2 was going down. But if you just go pull up the nominal chart, it's right there. Mm-hmm. And then the other thing is we've had, I believe, I'd have to look at the chart, but I think since late 2023, there's been over $2 trillion drained from that reverse repo facility. Okay. Now, a lot of that was money market funds that once interest rates were jacked up high enough, and they pulled their money out of the reverse repo facility so that they could invest in the treasury bills that the Treasury was issuing. If most of the Treasury issuance over the last couple of years has been on the short end, which is stupid because, they're paying over 5% to issue 1 year and under paper when they could be going out to 10 or 30, and at one point you could issue 10-year or 30-year paper for under 4%. Mm-hmm. But that's where the liquidity was coming from. The banks didn't have the liquidity to fund the longer end of if they did auctions at the longer end. So most of that, a lot of that $2 trillion has been used to finance the Treasury deficit. And then a lot of that money eventually recycles back into the financial system. And then the stuff that hasn't been used to the banks also put money in the reverse repo system, and they're using that to help prop up the markets. I mean, you've got an economy that's essentially sagging. Most companies aren't showing earnings growth or revenue growth. So you've got this sagging economy, and the stock market doesn't reflect that reality to any extent, right? So the liquidity is being used to prop that up. But you also have credit spreads are the tightest on record. Credit spreads being corporate bonds from investment grade all the way down to junk. Mm-hmm. Are the tightest on record. And that's a function of the liquidity also. And I also, I mean, this would be impossible to prove, but I'm not alone in thinking this. I also think the New York Fed is in there, help keeping a floor under things, especially ahead of the election.
Mhm. Well, I mean, there's certain things like I look at the gasoline price and just kind of keeping that in mind going into the election here. And, from let's say last quarter to see it just kind of continuously dropping. That's another I don't want to say managed market, but it's another thing that keeps people happy going into the election, right?
Oh, absolutely. I mean, where would the price of gasoline be if Biden didn't drain most of the strategic petroleum reserve?
Mhm. Well, there's a couple different ideas. One I went through with Vince Lancy recently on actually the role of actually needing the SPR still, which I think are quite interesting and quite valid. The role that it used to play versus the role that it needs to play now. But we have plenty else to get into for this interview. But Dave, what do you see as the Fed's next move here? Their next consequential meeting is in November, and we're not too far away from that right now. So what do you see as their next move?
I don't know. I mean, from the numbers that I look at, and forget the CPI, the real rate of inflation is much higher than what the CPI says, and it's starting to kick up again. I mean, it's a function of both the Fed allowing liquidity into the banking system and into the financial system. I mean, the financial conditions right now are very easy.
Mhm.
And it's also a function of the government deficit spending and government debt issuance. Because, the government with its spending is competing for resources with the private sector, right? And it's a supply and demand thing, and you're going to drive prices up. And you're seeing that at the wholesale level. So the regional Fed banks release business surveys, economic surveys, manufacturing surveys every month, as well as there's some private organizations that also release them. And one of the things that's been very notable over the last, I would say, since July, I think, is that part of the feedback is, the respondents to the survey have been flagging the fact that their input prices have been rising. And then at some point that's going to filter through to the end user of these goods and products. So and I think just as a result of M2 rising and that 2 trillion that's been drained from the reverse repo facility, I think we're going to start to see inflation really flame up again. And the other facet of this is if you use a real rate of inflation, even at where's is Fed funds, is it 475 to 5%, whatever it is?
Mm-hmm.
I think that's what it is. Maybe it's 450 to 475. If you use a real rate of inflation, like just use John Williams' 1990 alternate, which just calculates the CPI the way the BLS did in 1990. If you just use that, and that shows 8% inflation, then real rates are negative.
Mm-hmm. And
that's inflationary also, because real rates mean, the banks are borrowing money. They're actually getting paid to borrow money. So it's creating more money, right? The Fed has to print that money in order to, make the payments for borrowing that money. That's theoretical, but negative rates are definitely helping fuel higher prices.
Mm-hmm.
And I think we'll start to see that in a major way, in the first and second quarter of 2025, because there's usually a lag between when liquidity hits the market, when the Fed cuts rates, and when inflation kicks up.
Mm-hmm. Yeah, I mean they're always stuck between this, or they're really stuck between a rock and a hard place, between managing the economic reality and also managing the inflation rate at this point, and
managing the markets.
Yeah.
So I guess to answer your question, it's the consensus seems to think they're going to cut rates again, another 25 basis points, and then and then pause for a while. I know the Fed knows what the real numbers are. The economy's in bad, it's not in great shape. And I know they know real inflation is much higher than what the CPI. I mean, the Fed has the biggest and most sophisticated research department probably in the world, for sure this country. And so they know the real numbers. And so for them, it's kind of a quandary because, we need to lower rates to try and goose the economy. And I'm not sure it's going to work this time around. But at the same time, if we keep lowering rates, inflation is going to get out of control again.
So Dave, obviously, as a comparison tool, gold being priced in dollars, this sets up a great position for gold right now. What all of the stuff we just talked about. What about for silver? Is there a lot of factors that are playing into a potentially explosive point for silver right
now? Funny you should ask that, because I was just looking at a 40-year weekly chart of silver. And I mean, I'm sure you've seen it. There's a massive technical cup and handle formation that goes back to 1980 when silver peaked at 50. So there's the 44-year cup and handle formation. And then within that, there's another cup and handle formation that started in 2012, mid 2011, when silver peaked at 49. And then if you really want to, I mean, this is maybe overkill, but if you look at just a 1-year daily chart of the price of silver, there's an inverse head and shoulders formation that formed at some point this year. So I guess actually the inverse head and shoulders formation formed starting in late 2020. So, I mean, and I think if silver, they've been trying to hold it below 34. I think if it gets into the high 30s, we'll see 50 very quickly, like maybe by the end of next summer, if not before. I mean, silver, in my opinion, silver looks explosive. And obviously Russia is pouring gasoline on that fire. I'm assuming you saw that announcement that they're going to start buying a lot of silver. Their central bank is. And I mean, let's face it. Yeah, it's an industrial metal. And that's what I believe something like 70% of silver is used for, is industrial purposes. Obviously, the green economy, EVs, et cetera. But it's first and foremost a monetary metal. It's the oldest monetary. It was used as money before gold was. And so at some point, we're going to start to see, the poor man's gold aspect of silver kick in. And what I mean by that is, so there's probably like less than 1% of the populace that, has been accumulating physical gold and silver. And at some point, the public who has capital or cash or savings available, because the majority of households don't really have much in the way of savings anymore. But those that do are going to they're going to look at gold and they're going to say, I'm not paying $3,000 an ounce for that. Oh, I can get gold for $50 an ounce. And I can get a lot more of it than paying $3,000 for an ounce of silver. And so
for $50 an ounce.
Yeah. And at this point in time, it's my opinion that retail buying of gold and silver doesn't really affect the price. But it will if we just start to see, instead of 1% of the populace buying gold and silver, if we start to see that move to somewhere between 5 and 10%, then it's going to have a meaningful impact on the price of silver.
So Dave, if we have a meaningful move in the price of silver, what happens to the banks that have short positions in this type of rally?
That's a great question, because a lot of people just look at what their positioning is on the COMEX. And you can't really do that, because the biggest banks on the COMEX also underwrite and trade a pretty large amount of OTC silver derivatives. And we have no idea what those look like. That's intentionally kept very opaque. But it's also known, but banks like Goldman Sachs, J.P. Morgan, I'm sure HSBC, Citigroup, they keep physical gold over in vaults in Shanghai, Hong Kong, and Singapore. And I know specifically, because I remember reading articles about it several years ago. I know specifically JP Morgan had announced at one point that they were going to build precious metals vaults in Singapore. So we don't know to what extent these banks that are short on the COMEX, in terms of the financial impact, if we get a big short squeeze in silver, which I think is coming, in terms of the financial impact on the banks, we don't know what if they're hedged on the other side. It's likely that they are. I mean, the people running these banks aren't idiots, right? Mm-hmm. So, yeah, they may spill a lot of red ink on their COMEX positions, but is that offset perhaps by corresponding physical positions in the physical metal that they keep over in Asia? Mm-hmm. I don't know the answer to that, but that's what I suspect.
Mm-hmm. But what happens to those actual positions as the price ratchets up? Do they have, how does that end up affecting, their ability to buy that contract back?
Well, that's what'll, cause the price to rocket higher. I mean, that's toward the end in 2000 when silver peaked in, I think it was March 2011, started heading south in April. That's part of what we saw, probably in the last 3 to 6 months of the run up in the price of silver, because it ran up very quickly to 49. Mm-hmm. I mean, so the COMEX, the futures market is a net zero sum game, right? For every short position, there's a corresponding long position. So what'll happen is some of the hedge funds and CTAs, as the price really starts to run up, they'll start feeding their longs into back to the banks. So that's, I don't know. I think, to me, the more interesting question surrounding the COMEX is what happens if even just 10% of the hedge funds that are long silver contracts and gold contracts ask for delivery. But not only that, don't just tell me that don't show me a piece of paper that said you pushed my gold and silver bars from your part of the vault to an allocated account that has my name on it. I'm taking delivery of those bars. And that's to me where it gets interesting, because clearly the value of the short position in terms of number of ounces in both gold and silver far exceeds the amount of gold and silver that's available to deliver to parties that want to take delivery, and not only take delivery, but remove those bars from the vault. Mm-hmm. I mean, if I was running a big hedge fund and I was taking delivery of gold and silver on the COMEX from, converting my long positions into gold and silver bars, there's no way I'd keep those in a COMEX vault. Mm-hmm.
Dave, part of the opacity of this market is something that presents a challenge to really understanding all of the positions and what everybody has, and the ability for some of these players to actually be able to deliver on these promises in some ways. The fundamental production deficit has been talked about for ages here. When do you think that deficit actually starts to matter?
It may be mattering now. That may be part of what's pushing the price higher. So I'm not really sure how they've been able to make up for the supply deficit. So,
well, that's why I bring up the idea of the opacity of this market, because, if you sit down and just look at 1 year's production deficit, you think, oh, this market's about to explode. Yet it hasn't for several years. And this is typically pointed to as being a major catalyst for the market. So when we obviously the silver or these leasing, the ability to lease the silver into the market has been able to kind of make up that supply on the margins up until now. But that's why I bring up that, the opacity of the market and how that kind of plays into the ability for the market to be in some ways, as you said, managed at this point.
I take back what I said. They're using SLV to make up for the deficit, right?
Okay.
So, and I stopped looking at SLV and GLD are frauds, and JP Morgan basically controls the fate of the silver bars there, and so, and again, you can't prove this with hard evidence because, as you say, the opacity of the market.
Mm-hmm.
But it's widely thought by many people who have looked at this, have studied the prospectuses of GLD and SLV. I went through the GLD prospectus word by word, punctuation mark by punctuation mark back in 2009. And James Turk was the first one to do it when the original prospectus was filed, and he flagged it for what it is, which is there's no safeguards in here, and no mechanism to force a bona fide independent audit so that you can verify that the gold or the silver bars that they claim to be in those trusts is really there.
Mm-hmm.
So I suspect what happens is when one of the big banks that has exposure to silver derivatives, when they need to make deliveries, I think they move it out of SLV vaults and make the delivery. And then when they have an opportunity to put the gold or silver back in there, maybe they do, maybe they don't, who knows? Mm-hmm. Again, we won't know until there comes a point at which there might be a default by one of those two trusts. Mm-hmm. Now, I have heard, and again, this was back in 2014, and this person's a well-known precious metals analyst and wanted to comment back then off the record, but he had heard of a couple. So there's a mechanism in GLD or SLV where you're if you own enough of the shares, you can exchange them for gold bar, 400-ounce gold bars or 1,000-ounce silver bars. And he had heard back then that a couple wealthy guys had tried to do that, and with GLD, and GLD wouldn't let them because there's a mechanism in the prospectus, a provision that in which GLD can deny the ability to do that at their whim, basically.
Mm-hmm. It's interesting to be able to kind of take these different pieces of news and put them together in a way that paints a broader picture. As we're talking about this, the fundamentals not necessarily driving the market right now, this fundamental production deficit. Mexico's new president, Claudia Sheinbaum, had open pit mining to be banned on her basically list of promises when she was, or if she was to be elected. And now that has been reversed and is off of her promises. So does this really show the importance of silver to the rest of the governments of the world, or just the mining industry as a whole to Mexico?
Well, first I'll say, if you notice, she had put that on the government website after she got elected, but AMLO was still in power. Mm-hmm. The day after AMLO stepped out of office and she took power, then she removed that promise. Mm-hmm. So, and it was kind of known by a couple of the CEOs who have projects down in Mexico that I talk to often, that it was kind of known that she was not making a ban on open pit mining part of her priority list. Mm-hmm. So, yeah, I mean, I think I don't really know what the impetus was for the leftists down in Mexico, because the leftists have been in power. She's a leftist. She's allied with the leftist political party. I don't know why. I mean, a well-built and regulated open pit mine is really, I mean, there's risk that it could harm the environment, but I mean, the technology and the way they construct these things now is so sophisticated that it's rare when there's an accident that's a bad accident. So I'm not really sure what the impetus was to ban open pit mining, especially because a lot of these mines are in out of the way places.
Mhm.
So, but yeah, I mean, mining's an incredibly important part of the Mexican economy, and it attracts capital. I mean, if they banned open pit mining and continued clamping down on mining regulations, it would have chased away a lot of foreign capital investment.
Mhm.
So, and I was told, because one of the companies I cover and recommend is Discovery Silver, and I was chatting with them about this back in the spring because they're in the process of getting a very large open pit silver mine permitted,
Mhm.
and I think they expect to get it by the end of this year. But they pointed this out, as did a couple of the other CEOs that I chat with, was that Claudia Scheinbaum is a scientist, and so is the new head of the SEMARNAT. That's the environmental regulatory agency there.
Mhm.
And because of that, they figured she would be a lot more practical in her thinking and decision making when it comes to mining.
Mhm.
So and that appears to be the case.
So, Dave, are you, because of these types of setups, does this attract you more to, let's say, silver miners and be focused on silver miners than, and maybe a better way is to say it is to favor silver miners over the rest of the mining complex because of this type of setup?
Yeah, that's a good question. But first, I wanted to mention something because you said, silver hasn't been explosive. And you're right, it hasn't gone parabolic, but it's up 50% since mid-February.
Yeah.
That's better than the NASDAQ. That's a good question. I mean, you want to be long silver miners when silver really takes off because their prices will explode. But part of the thing is when there's only one pure, there's only one company whose mines, what they produce from their silver mines is 100% silver, and that's Aya Gold and Silver.
Mhm.
And then the next highest is Mag Silver, and then Endeavor Silver, and after the top 4 or 5 silver producers, then you're getting down to 50% of their production is silver, and the other 50% is either gold or base metals, or even lower. So, for instance, people still regard Hecla or Coeur Mining as silver miners, and at one time, that was the majority of what they produced. But like Hecla's Hecla's less than 40% output is less than 40% silver, and Coors is almost down to 20%. Pan American Silver, which is like it's a cult stock among silver freaks. I don't want to say silver freaks because I guess I'm a silver freak also, but uh, Pan American Silver, I mean, the percent of silver in their production profile is under 20%.
Mhm.
Most of it's gold. So it's hard to find pure silver plays. Like even the ones that have projects down in Mexico now, right? Like a Vizsla Silver or fill in the blank. A large part of their resource is actually gold and base metals. So, but I will say, and again, I have subscribers all the time that ask me questions. What about this silver company? What about this silver company? And a lot of them, just looking at them, they look to me like I don't know if they're going to get their project to the finish line, and they've already issued a lot of shares.
Mhm.
Or it may be a small silver producer that isn't even profitable right now. And they asked me if they should be buying those, and my answer is, well, at some point, the rising tide is going to float all boats, and a lot of these stocks are going to do well despite their fundamental backdrop, just because they have silver in the name of the company.
Right.
That's how it was in the first big run up between 2001 and 2011. Mm-hmm. And we're going to see that again. A lot of these silver stocks have doubled and tripled already. And legitimately, some of them should, because if you look at like Gold and Silver, and that's one that I follow and recommend and own. First of all, they're all-in sustaining cost of production, and I know that's a controversial number. Their all-in sustaining cost of production is among the lowest in the world among silver producers, and because they're producing relatively high-grade, 100% silver, their upside leverage to every dollar rise in the price of silver is unbelievable. Mm-hmm. The same can be said for mag silver, because over 70% of their production is silver. And so that's what you're looking for in these companies that, produce a decent amount of silver as part of their production profile, because their upside leverage to the price is just going to be phenomenal, especially once you get to the point where the price is well above the all-in cost of producing each ounce of gold or silver. Mm-hmm.
Dave, is that part of what makes silver per ounce so much cheaper to produce than gold? Is it because of this byproduct production, or is it because it's so much less rare than gold is?
Actually, silver is more rare than gold. It's a much smaller market, but I don't know that you can say generically that it costs less to produce silver than it does gold. It depends on each particular mine and the type of rock that they have to process, and the type of processing that they have to do to extract the silver from the ore. Mm-hmm. So, but yeah, and the accounting for the all-in sustaining cost is controversial. I don't think it should be as controversial as people make it out to be. And the use, I don't see what's wrong with using, if gold and base metals is not a big part of your production, I don't see what's wrong with using, the profits from those materials to lower your all-in, the profile of your cost of production. It's 6 of one, half a dozen of the other, right? Mm-hmm. You could choose to recognize that as revenues. It's probably not going to affect your revenues that much, or you can use it as a cost offset and make it look like you have a lower production, cost production profile.
Mm-hmm. Dave, how do you think about the difference between speculating and investing in some of these silver plays? Is there a material difference to you?
Well, in a way, it's all speculation, right? Buying any stock is speculative, right? Because there's risk. It's risk that you might lose part or all of your money. Mm-hmm. So the way I look at it is, again, it's on a company by company basis, and you segment the sector into the large cap producers, the mid-tier producers, the small cap producers, and then you have what I like to call the micro cap junior project development companies, and that's speculative. That's 100% speculation, and if you get a few right, you're going to make a lot. You're going to make more than enough to offset what you lose on some of the other ones that don't work out, because most projects never make it to the finish line. Mm-hmm. It seems to be a higher percentage now than when I first started back in 2001, and I think a big part of that has to do with the technology in finding deposits, and also with just the general technology and engineering these mines and complying with environmental regulations. Mm-hmm.
When going through some of your work here, in preparation for today. It seems like Eric Sprott being involved in a deal is something that a lot of people follow or look to see if to maybe confirm something that they're interested in. Is this something that you take into account if Eric is in a particular company or at least interested in it when you look at these companies?
If I see that he's invested in a company, it'll I'll take a look at it.
Mhm.
It'll incentivize me to take a look at it. I mean, he's a really bright guy. He's been around a long time. He's got, I know he has at least one geologist he uses as a consultant. He probably has a team of them. But I tell my subscribers, and I adhere to the policy of don't invest in a company just because Eric Sprott is in it. And a lot of these juniors, they over promote the fact that he's an investor in their company. You'll open up their corporate presentation, and on page 1 or 2, Eric Sprott owns 10%, Eric Sprott owns 20, whatever. So, but because what he's doing is what I would do if I had his bankroll, right? He's a billionaire. And so he knows the probabilities that a project is going to make it from start to finish. But he also knows if he has investments in 100 juniors, and if 20% work out, he's going to make way more than what he loses on the companies that don't make it. So, but what I like is when I get into an idea and recommend it and invest in it before he gets into it. So Heliostar Metals is an example of that. Discovery Silver, which I've been involved in since it was Levon Resources, before the new management team moved in and they changed the name to Discovery Silver. So that's when I kind of feel vindicated if I'm in an investment already, in a company already, and then it's announced that he's taking a stake in it.
So, Dave, are you actively, let's say, looking for M&A targets to speculate or invest in because of that upside potential?
I mean, again, it's, I think you got to really just analyze a company and make an investment decision based on the company or the project that the company is advancing on a standalone basis, and not worry about whether or not it's going to get taken over. Because it's, trying to guess which companies are going to get taken over is difficult. It's going to get, we're going to start to see a lot more M&A, assuming the prices of gold and silver continue to rally and move higher. We're going to start to see a lot more M&A, and we're already seeing more M&A. So Minera Alamos just announced the acquisition of, I think it's, what the hell's the name of it? Saber Gold or something like that. Yesterday, and it's got a small gold mine project down in it was a historically operating gold mine, and they're gonna recondition it and bring it back into production. And it's small. It's going to be like 40,000 ounces of gold a year, but and that's down in Arizona. Integra Resources acquired the Florida Canyon mine, and then Heliostar Metals is buying Florida Canyon's Mexican assets. So, you're starting to, we had been seeing some M&A activity amongst the big boys, right? And now you're starting to see it filter down into the smaller companies. And at some point, right now, the trend in the industry is that if a producer is going to acquire a junior project development company, they typically wait until it's completely de-risked, right? And by that, I mean, at least has been issued all the permits it needs to build and operate a mine. And that still leaves execution risk, right? Because you have the execution risk of, can this management team do this competently and efficiently? And so sometimes, it had been the case that the large caps weren't acquiring project development companies until they had a mine in place. Well, now we're starting to see it while the mine is still, being advanced, albeit it might be, highly advanced. But we're starting to see that. So, yeah, I mean, I think the best policy to have is just find a handful of stocks that you like and you want to invest in, and decide whether you want to ride the gold wave or the silver wave or both, and just sit back and enjoy the fireworks, assuming we continue to see gold and silver moving higher. Because if you own, let's just say you own 10 juniors, at some point, one or two of them is probably going to get taken over in the next year or two.
Mm-hmm. Well, kind of to that point, Dave, do companies, let's say in different parts of the cycle, or maybe towards the end of the cycle, do companies need to have a PEA or feasibility study in place in order for you, or let's say other larger companies, to be interested in their project? Or for example, for a company to be following the story, can the drill results tell the story without necessarily needing to spend the money on these studies?
So the way it works is that when a strategic investor in a junior with a good project, what happens is these juniors sign confidentiality agreements with who's ever interested, whatever potential strategic investor is interested, and that gives them access to their data room, mm-hmm. right, and access to the core room, so they can look at the drill cores and they can analyze all the data, and because there's a lot of information that doesn't get released to the public, because that's just how it works, right? So these companies, if they decide to make an investment in a junior, they've already done their own homework. They've already made their own PEAs that don't get public. They do it for their purposes, right? That they're kind of, they'd be fighting against themselves if they took their PEA work and released it to the public, right? Because then the public would say, "Oh, wow, this looks great. I'm gonna buy shares," and that would drive the price up. Mm-hmm. So a good example of that is Eldorado Gold, which earlier this year took a 9.9% stake in Amex Exploration, which is another company that I own and recommend and cover in my newsletter. And they, I mean, by the time they decided to make that investment, they had already worked the numbers out to their and saw and decided they liked the project. So mm-hmm. that's kind of what happens. You need to have an advanced stage PFS, pre-feasibility study, or feasibility study in order to get financing for construction. And then there's a lot of funds, and those would be the PEAs that the company, or the PFS that the company prepares and releases for public consumption. A lot of funds won't invest in a stock unless it at least has a preliminary economic assessment that's been prepared and released. Mm-hmm. So I see what you're saying. I mean, because there's some companies that just keep drilling and releasing drill results, and they don't put together a PEA. I mean, at some point they need to, unless you're like Great Bear and you're able to get away with getting acquired without ever, producing an economic study for public consumption. Mm-hmm. But I guarantee you, Kinross had already done all of that for itself before it paid what it paid for Great Bear.
Well, that's what I mean. I think in that case, with that, let's say, shining example, that can be one of these cases where they can release drill results, and the industry and these big players see, the possibility of the potential size of this deposit and the grade that it also presents.
Right, but that's kind of an outlier case at this point in the
totally.
Cycle, in this bull cycle. It will get to that point because competitive forces will force that issue, because a lot of these large mining companies and even the mid-tier mining companies, at some point, they're going to want to make acquisitions of junior development companies that have a valid project and have, measured resources in the ground, right? Because that's it's not the ideal way to add ounces to your reserve pile, but it becomes a practical way to do it.
Mhm. Do offtake agreements or royalty and streams on some of these projects make you shy away from a particular company, Dave?
Again, it just kind of it depends on each individual situation. I mean, my preference is that companies try not to do streaming agreements
Mhm.
or issue royalties, but in many types of financing environments, it might be the only way to get money raised, or it might be the best way to get money raised. Because I also hate it when, I know they have to do it. And, I get ticked off when people whine about juniors who do share deals, right? Yeah. How else are they going to fund the development of their project? It's not like banks are knocking on their door to give them loans for that, right? So that,
Which
you
some
have to
people
issue
see.
shares. It's when they start issuing a lot of shares and don't make a lot of progress, and all of the share issuance have warrants attached to it. I mean, I do prefer when a company like tries not to have to do a deal that includes warrants on the stock. But again, if it's a tough financing environment, it can't be helped.
Mhm. Do you ever look at any of these royalty and streaming companies as possible investments as well, Dave?
And I should. I have, and I'm familiar with many of them. I just, yeah. They have great upside leverage to gold and silver prices, but I think if you can pick the right junior projects, you can make a lot more money. It's more risky, but you can make a lot more money than you can on the streamers.
Mhm.
So,
Just because of
a
that risk
perfect example
profile.
for me, and this was Silvercrest Metals, and I knew that deal or that project was going to be a home run because I was familiar with it when it was Silvercrest Mines and First Majestic tried to acquire it, and the management team and the board at Silvercrest Mines wouldn't sell them Las Chispas, and I told my contact at the company, I'm like, look, because it started out private, and then they eventually went public. And I said to him, look, as soon as you go public, call me because I want to buy shares and I want to put it in my newsletter.
Mhm.
And I actually flagged it at 16 cents a share. And I think where's it trading now? It's trading at 10.79, and this was back in early 2016. So, and that's an example. You're not going to get returns like that on a streamer.
Mhm.
And again, that's kind of a unique one-off situation, but still, so for instance, I follow and recommend there's probably at least 5 of my junior project development companies that I follow, recommend, and own that I think have the potential to be 10 or 20 baggers.
Mhm.
And so that's why I focus on, and I do cover some producers. I don't like Newmont, and we saw why last week when they announced their earnings. I'm not a Barrick fan. There's a couple large cap producers that I like. I like Goldfields, but I don't spend time analyzing those companies. I look at them to make sure I understand what they have and where they're going. But there's so many eyeballs on those companies, and there's so many Bay Street and Wall Street firms that cover them. I can't provide value added to my subscribers other than to say, you should be diversified into some of these, and here's the ones that I like and why.
Mhm.
So, and there's some where I think there's good value right now is in the mid cap types of producers, like Caliber Mining or Fortuna Metals. And they both operate in what are perceived as risky jurisdictions, but if you really drill down deeply into it, like where Caliber operates in Nicaragua, I mean, that my initial thinking on Nicaragua before I really looked into it was that no, it's too risky, right? It's former banana republic type Central American government, but no, the government down there is extremely pro mining, and they're collecting a lot of taxes from the mining that goes on down there.
Mm-hmm.
So, and that's why I think there's value there, because I think Calibre Mining trades at a discount to where it would if its mines were, and it has a Nevada mine, but if those mines were in Nevada instead of Nicaragua.
Right.
So, and I think the startup of production for the Valentine mine, which they acquired by acquiring Marathon Gold up in Newfoundland, that I think it's supposed to start up either in the first or second quarter of 2025, and that's going to add a lot of gold to their production profile.
Mm-hmm.
I mean, they're going to become a 500,000 ounce a year producer. So, and I think they're based on where the typical 500,000 ounce producer trades in terms of market cap. They're very undervalued to their peers.
Mm-hmm. Excellent, Dave. Are there any other, let's say, ideas or some good things to keep in mind in order to be successful when investing in this sector that we didn't cover?
I mean, it's a challenging sector to invest in, because there's just, you've got all kinds of risks, especially if you're investing in the juniors. Mm-hmm. Not as much. So that the largest cap stocks, they're basically going to move in tandem with gold and silver, right? Maybe they'll have a 1.5 or 2 times beta versus gold or silver. And they're, they have liquid, the trading in their shares is liquid. But you especially when you're looking at juniors and small cap producers and mid cap producers, I mean, you got to look at, jurisdictional risk. You got to look at, and the political risk it's not just the risk of getting nationalized. I mean, we saw AMLO weaponize the environmental agency in Mexico during his term, Semarnat. Mm-hmm. And they went after Fortuna twice and lost. So you got to, there's jurisdictional risk with the project development companies. I mean, there's management risk. What's the experience of the management? Have they successfully taken projects from start to finish in the past, or is this their first go around at it? There's financing risk, particularly back in the 2012 to 2015. A lot of these juniors went out of business because they couldn't raise capital to stay alive. Mm-hmm. And then there's geology risk. You might have a fair amount of gold in your deposit there, but how easy is it to extract it from the ore? So there's risk there. And then obviously, you might have a nicely polished up project ready to get, and you're ready to make a construction decision, and for some reason you can't get project financing for it. And then even if you get to that point, I mentioned earlier, there's execution risk, and that's the execution of getting the mine built and up and running with as few snags as possible. There's been a couple companies that I've followed over the last, let's call it 10 years, that have had issues getting their mine up and running. So, I mean, there's a lot of risks in the sector, but if you're able to manage and time your entry and your exit, correctly, and pick out the right stocks, you can make a lot of money.
Mm-hmm. Well, it's certainly a complex and I think somewhat intimidating sector to get into, but I appreciate you, sharing with us your views on it and why, there's a fundamental setup here for these stocks, and understanding the intricacies of how to kind of analyze these is really important. So I really appreciate that.
Well, the mining stock sector right now is the only time it's been a better value in the last 23 years was when the secular bull market started back in 2001, 2002. I mean, when you look at the valuation of the mining stocks relative to the price of gold, it's not at an all-time low, but it's near an all-time low. And then if you look at the valuation of these mining stocks relative to the S&P or the NASDAQ, I mean, they're very cheap relative to the rest of the stock market as well. So, I mean, for me, it's one of the few areas of the stock market that can be considered a value investing sector right now. I mean, that's going to change when we have our eventual blow off top in the sector, but you can truly generate alpha if you pick out the right stocks.
Excellent, Dave. So for those that are interested in finding out more about you and the mining stock journal that you write, that's all available at investmentresearchdynamics.com, as well on Twitter. Excellent follow. You cover a lot of different topics there at INVRES Dynamics as well. Dave, thanks so much for your time today. Really appreciate it.
Thank you, Tom. I enjoyed it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.